we want to discuss in Chapter 7 educational planning. And we're not going to get into a lot of detail, but we will discuss the basics of the general plans and instruments that can be used to save for college education. Most of these facts I'm sure you're aware of. You know that the tuition is going up. The average debt, this is in 2009, is $23,000. I'm sure that's up even higher now. As a general rule, I mean, the sooner we can start saving for education, the more money we'll have to put towards college education. It's one of the biggest costs of a family. Obviously, you can get estimates of how much it costs by visiting a variety of colleges. They now provide information on what 4-year costs can be. And essentially there are two basic rules, right? I mean, for parents who have time, they can obviously utilize the compound value of money to work in their favor. But you don't have to save it all. I mean, I don't think parents should have in mind that they need to save and have the total amount necessary for college. They don't need to fully fund their kids' college education. There's lots of ways to pay for college. You can look at a variety of techniques or tools. There's the Educational Needs Analysis Worksheet. And again, without getting into a lot of detail, if you know what it currently costs for school, apply a inflation rate that you think fits what college is, or what the inflation rate of colleges are. What's the current age? What's the first year they're going to attend college, and how many years will they be there? We then need to estimate, have we saved any money already? What's the average investment return that we can receive? Now, in this exam, we can apply a tax rate. You could obviously save just by putting money into an IRA or into a savings account or by buying stocks, etc. But you'd have to pay taxes on that income between now and when the money was ultimately used. Then as it's being used, there could be capital gains, etc. We're going to assume that for the most part, we're going to use the tax-deferred tools to save for college. So in this case, you can see that it takes approximately, for this first person, it's going to take about $83,000 to pay for college. $3,600 is what they would need to put down now if they did an annual amount. If they did it in monthly payments, they would need about $295 a month. Likewise, for the other person, they need $3,000 in annual payments or $253 in monthly payments. So, it's obviously a substantial amount of money. We need to plan if we want to help our kids move forward. So there's several different kinds of plans. The first kind of plan that we can talk about is something called an UGMA account. And UGMA and UTMA have to do with basically it's a trust. It depends on what state you're in. If I'm not mistaken, Ohio has the UGMA accounts. That's the Uniform Gift to Minors Act. And if I'm not, I'm fairly certain that Kentucky is an UTMA state, which is the Uniform Trust to Minors Act. They both act the exact same way. They are accounts that you set up where you place an irrevocable gift. And that's essentially the big part here, is that it is an irrevocable gift for the student. so that once you start putting money into these accounts, you can't take it back out. This money is locked up into their accounts. So I think it's just important to understand that it is an irrevocable gift. It's taxable. Now the first amounts are very low tax. Some of it's taxed at the kids' account. But after we get to a certain amount, if I'm not mistaken, the current amount is $1,900. Then the amount after that is taxed at the custodian's tax bracket. So eventually there'll be some higher taxes paid. It's not just at the kids' tax rate. One of the biggest challenges here, though, is that when the minor turns to majority age, they will then have access to the funds, and this creates some challenges if the child can use it for whatever they want. So that could maybe the money won't be used for college like you were planning. A Coverdale account is a tax deferred account. You put money into it's a gift. You put it into this account, and it grows tax free until it's distributed. Now, if it's distributed for educational purposes, then it's going to be distributed and it will be tax-free earnings. You can use this for any kind of school, not just education, not just higher education, but secondary or not just secondary, elementary school, high school. Could be used in vocational schools, and it can be used for tuition, room and board, books, etc. So it's a basic way that we can help save and move forward with our accounts, so with our savings plans, so we can do this in a tax-free basis. So are there some other rules that are involved? Currently, the most you can put away is $2,000 per year, and you can only do that for one account. So the challenge is what happens if Grandma and Grandpa want to contribute to the kids' college education? The maximum per Social Security number per beneficiary is $2,000. So we may have to coordinate something here. But the donor doesn't have to be the custodian or the person that sets up the account. It can be anybody. If you don't use the funds for educational expenses, it's going to be taxable income, and there'll be a 10% penalty. Now, money can be rolled over into a new educational savings account for a different beneficiary. So say this person decides they're not going to go to college, they're not going to get a higher education. We can roll this over into another beneficiary, and then they can take advantage of the tax-free earnings for this particular account. There obviously are some rules. It has to be done within 60 days so that it won't be taxable. Any distribution is tax exempt when you claim the HOPE credit. So you can take the HOPE credit and you can take or the lifetime learning credit, as long as you don't use it for the exact same expense. And again, we have talked about here, once you get to age 30, there is a distribution, or you have to roll it over. If there's a distribution that's not used for education, again, there is a tax, an income tax, and you're also then going to be subjected to a 10% penalty. Another kind of a plan is called a Section 529 plan. And again, this is what's referred to as a qualified state tuition program. And there's lots of rules and regulations, but this works very similar to a Coverdale account. The differences are, quite frankly, how much money can ultimately be invested, right? The earnings are tax deferred, but you could actually put up to $300,000 into this account. In any one year, again, the number of donors doesn't matter. More than one person can donate in a year. There's no limit to $2,000 per Social Security number. So if you had $10,000 and your wife had $10,000, Grandma and Grandpa each have $10,000, and the other grandma and grandpas, they all have $10,000. That's $60,000 that all can be contributed in 1 year. It is a tax exempt status, so you're going to be able to get this tax deferred benefit as we move forward. Now again, one of the things we're talking about, this is a gift, so the gift tax consequences are going to come into play. Now when you're going to get your you have the up-to-date rules in 2013. This actually changes to 2014, right? Which means you can do 28,000 total. And this, let me just go ahead and change this as we're doing this. And of course that can be leveraged out here that over 5 years. Again, we could add 5 years here. That's 70,000, and then for 2 people here, this is obviously 40,000. So in any 1 year, a husband and wife could contribute 14,000 each into an account, or 28,000 total. Or if you had 70,000, you could do it all in 1 year. Now, if you did $70,000 into the account this year, as an individual, you put that into your kid's account, you cannot contribute for the next 4 years. So what this does, it allows us to take lump sums and get it into the account and take advantage of compounding. But we also then, to not violate the gift tax laws, we have to let this stretch out. Again, tuition credits can be deferred tax-free from one qualified program to another, so we can switch between programs. And again, as long as you don't use it for the same expense, you can still take the Hope Scholarship and or the lifetime learning credits that you can get from taxation, even though you have these 529 plans.